Okay, so what we have started learning starting yesterday and moving forward is something that they call the accounting cycle. And this is like, it's kind of weird because we don't do it exactly the same way as they did back in the olden days, but the processes are still important. And the first step of the accounting cycle is what we started on yesterday, which is we record transactions. So that's what we started learning, right? Those debit and credit recording entries that we started on yesterday. So in real life, accountants record transactions as they occur. So just chronologically, right? Today, these transactions happen, we enter them into the computer. Some computer systems at point of sale type businesses, say like Walmart that has cash registers, the cash register can actually just capture all of those transactions. And then back in the cash office, when the person brings their cash drawer back, they count up all the cash, make sure it matches up with what's on the register, and they just hit enter and it puts the entry in for them, right? So think about it, every time Walmart sells something, what they're doing is they're debiting cash and they're crediting a revenue called merchandise sales. And then they actually have to do another entry to, let's see, they would have to credit inventory to show the inventory going down that they sold. I mean, yeah, which means they would debit. What would they debit? Well, we'll figure it out, but they have to do two entries. We're not there yet. And my brain is morning brain right now. Anyway, so that's what we started learning was posting, uh, recording transactions, and we'll call that posting or just journal entries. That's those debit credit entries we started on. Okay. So the next thing we have to do is we have to learn how to post these journal entries to their accounts, because what we need is to know the balance of each account, right? So we did a bunch of accounts yesterday. We did a cash account, an accounts receivable account, an inventory account. We looked at liabilities like accounts payable. Oh, I forgot account. No, I said accounts receivable. We looked at revenue accounts like fees earned. We looked at expense accounts like wages, like wage expense, things like that. So there's all these different accounts. And in order for us to be able to do our reporting at the end of the financial period, we have to know the balance of each of those accounts. So after we do our journal entries, step 2 is to post the journal entries. This says to accounts. Sometimes you'll see it's called posting it to the ledger. And in the good old days, this was actually done in a book. And the book had 2 sections. The front section of the book, you would have all of these journal entries. Like each time there was a transaction, you'd write down debit, cash, credit, common stock, right? And then the second section was broken down by account. And so then you'd flip to the cash account and you'd show a debit to the cash account and then add the previous balance of cash to the amount you debited. So you'd show a new balance for the cash. And then you'd flip back to the common stock section and you'd show a credit to common stock and you would find the new balance to that. So what we're doing today, posting to the ledger, is that part where we want to like record these transactions not only chronologically like we do on the journal entry, but also by account so we can find the balance of the account. Okay. So it's going to look a little weird. And the way they have it do us in this with this textbook is like a lot of extra little things that can be confusing. That's why I want to walk you through it and we'll do a couple of examples of it. All right. So this looks a little bit terrifying. It's just too much information in one place. But this is an example of the journal entry, which we learned about yesterday, and then the 2 ledgers for the 2 different accounts. So here's a journal entry where they posted a $2,400 payment to prepaid insurance and a $2,400, so that's a debit, and a $2,400 credit to cash. What that means is they took $2,400 Probably they wrote a check or paid with a debit card, but they took $2,400 cash out of their cash account and paid it to their insurance provider to provide coverage for like the next year of insurance, right? So it's like in real life, all they did was probably like write a check and give it to their insurance people. And then they recorded it as a debit to the prepaid insurance asset and a credit to cash. Cash went down, prepaid insurance went up. So then the second step is to record these ledger recordings. So you can see, here's the account. It's a little hard to see because of the color. This is called prepaid insurance. All they do is they write the date, the amount they're debiting it, and then the balance. So prepaid insurance had no balance. It now has a debit balance of $2,400. The cash account, it has previous transactions, right? So it has a balance. It had a debit of 25,000 back in November 1st. Then on November 30th, it was credited. Oh, that's the one we just did. Okay. No, what are they doing here? Apparently there's other stuff here we can't see. So our balance as of November 30th was 5,900. And then we're going to credit the account another 2,400. Here's where it's a little confusing. If the account has a debit balance and we credit the account, then that's going to reduce the debit balance. So it had 5,900, we credited it 24, so the new balance is a debit of 3,500. So remember, when we do the examples and we do practice, you'll start to see how it all comes together. But remember that with an asset account like cash, debits increase the account, credits decrease the account. So if it had a balance of 5,900 debit, that means we had $5,900 in our cash account, probably like a checking account. And then we credited that account 2,400, meaning we took 2,400 out of it. The new balance is a debit of 3,500. So what can be confusing is if we have a debit balance and we credit it, then we're going to subtract. If we had a debit balance and we debited the account, that would be adding money. So we would add the two. And that's where it'll be easier when we do some practice. Okay. So this is how we go about doing a ledger entry, or posting our journal entries to the ledger is probably the right term. So here's another example. NetSolutions pays rent for December, $800. So again, if I was going to figure out my journal entry, I'd say, what's happening? Well, paying my rent expense. The rent expense is going up. Paying it with cash. So my cash is going down. What type of account are they? Expense and an asset. How are they affected? Well, if an expense is going up, it's debited. So I'll debit rent expense. And if cash is going down, I'll credit it. So it's a credit to cash. So then, how do they do that? Then we'll post that to the account. So a minute ago, I showed you this style of ledger where it shows each of our debits and credits and the balance it leaves. Sometimes you'll see it in this style. This is called the T account style, where you just show your credits and your debits and your credits like that. Okay, it's the same thing. And when we do an example, it'll become clearer. Okay. Transaction 3, we receive an offer from a local retailer to rent land purchased on November 5th. The retailer plans to use the land as a parking lot for its employees. NetSolutions agrees to rent the land to the retailer for 3 months with the rent payable in advance. So then finally, we receive $360 for 3 months rent beginning December 1st. So what's happening? We're receiving cash. Cash goes up. That's a debit. And because they're paying us in advance for rent we're going to provide to them in the future, we're going to record that as unearned rent, which is a liability. Anytime someone pays you in advance, it's called unearned, whatever. Sometimes they'll call it unearned revenue. So there's our journal entry. And then they post it to this T account by debiting cash and crediting liabilities. The intent of these T accounts, or the previous version I showed you where it had all the balances, is simply so that we can track these debits and credits by account so we can find a balance on the account. That's all. Okay. A couple more examples and then we'll work one out. Purchased office equipment on account from Executive Supply for $1,800. Office equipment, asset goes up, so that's a debit. And accounts payable, which is a liability. He was like doing like the Goku thing, like he was moving. Accounts payable liability is also going to increase, and liabilities increase with a credit. There's our journal entry, and then to post it to our accounts, we just show the debit, the office equipment, and the credit to liabilities. Here's where your brain is probably right now. You're saying, I just put it as a debit and credit there. Now you're telling me all I have to do to put it as a debit and credit in the ledger is also put the debit on the debit side or put the credit on the credit side. That seems too easy. So I'm thinking you're going to trick me and something's going to be really hard about this. And the answer is it is not. Okay. The only difference is here is a chronological record of a transaction of something that happened. Here is a record. It's also got a chronology. We put the date, but it's a record by account. So that at the end of the month or whatever our financial reporting period is, we'll have all of those transactions listed by account. We can find the balance of that account and we can create our trial balance, and then we'll use that to create our balance sheet. Okay. So it's really as easy as it sounds once you get into it. Paid $180 for newspaper advertisement. We're going to call that a miscellaneous expense. Some businesses would call it an advertising expense. Just depends on where you're working. So we'll debit the expense, credit the cash, and then we'll show the credit to the cash, the debit to the expense. All right. There's lots of practice transactions. I think we'll be better off getting to it. I did want to show you this though. So at the end of the period, after you've been recording all of these things in the ledger, whether you're using a T account or this style ledger that carries the balance, okay, we'll have this long ongoing thing and we'll have a balance. We can see that our cash account started in November with a balance of 25,000, and then we've been debiting and crediting it all the long way. And at the end of December, it has a debit balance of $2,065. Okay, that's just a record of where the cash account sits at that point in time. Accounts receivable has a balance of 2220, supplies has a balance of 2,000, etc. More of the accounts. So again, all this general ledger does is it gives us the balance of each of these accounts. We got a lot of accounts. So let's look at a couple of the guided problems so that we can actually get our accountants don't really get their hands dirty, right? But we're going to get our hands dirty and work on this. It's pretty nice though when you're doing accounting work on a hot day. You look out the window and see people actually getting their hands dirty and sweating, and you're like, it's a pretty good job. Yeah. Here's what I've learned, guys. Ready? Education does not necessarily get you more pay, although the data says it does, right? You make more with a higher education. But for me, what it's really done is allowed me to have some benefits of like working in an air-conditioned place instead of out in the hot sun, which isn't a big deal when you're 20, but it's a big deal when you're 50. It's, you know, it's also given me a sedentary job so there's a trade-off, right? Although plenty of people who work construction also get this belly. So I don't know. Anyway, so getting an education really does like give you just some control over the type of work you're doing in the future, even though sometimes like I have friends who work at the mine who make as much as I do, right? And they love their jobs. But as they get older, they're like, I need to move into management or something because doing all this physical labor is killing me now that I'm in my 50s. So think for the future. All right. So the first one here, February 11th, 2019, the Quick Fix Company. purchased $2,250 of supplies on account. So here's the part that's a little confusing, and I'll explain it. So they want us to journalize that transaction. So the first part is we're going to put the names of the accounts. So if we're purchasing supplies on account, then I think what's going to happen is supplies and asset is going up. So I'm going to debit supplies, and accounts payable, a liability, is going to also go up. Supply or assets increase with a debit, liabilities increase with a credit. I'm going to skip over that post reference for a minute, and I'm going to come over to the debit and put in the amount 2250. Okay. So post reference is a little old fashioned, and that's one of the things I don't love about the way the textbook does this. Most of us use computers, like 99% of all people in accounting use computers and don't use the old style book. So we don't really have to put a post reference. But remember I told you in the old days, the book had the journal up front and then the ledgers for each account in the back. So what we would do is you can see we're on page 73 of the journal. So we would say, I'm posting this to supplies, and supplies has an account number of 15. So I've put for that post reference, that's going to account 15, which means if you want to find it, you turn to the back and find account number 15. A lot of times you set those books up with tabs, right? So you could just open it. And then accounts payable is number 21. And that's just given to me up here. So this is just our way of like being able to find the reference if we have a system that requires this. Most systems don't anymore. Like if you use QuickBooks, you just put in the account name, and then if you want to figure out what's been posted to that account, you just click on the account and it'll show you all the postings in it. All right. So there's our journal entry. And then the second part is for us to record to the general ledger. So it says, enter a debit balance of $400 as of February 1st, 2019. Place a check mark in the posting reference column. So what we're saying is, so we're going to click post reference, and we're going to say this account, supplies, has a debit balance of $400. So at the start of this fiscal period, February 1st, this account had a debit balance of $400. And now we're going to post this journal entry where we debited $22.50. So my post reference, I'm going to put the page number in the journal it came from, 73. And then I'm going to show that it was a debit of 2,250. And now I have to put the new balance of the account. If I had a debit balance of 400 and I debited the account 2250, what do you think the new balance would be? Yep. So since I had a debit balance and I did a debit, then I'm adding them together. So the new balance is 2,650. And what's interesting is this ledger should match up with real life. Like if somebody went into our supply, let's say we had a supply room or something, and added up the cost of all the supplies in there, it should add up to $2,650. This represents the cost of all the supplies we have. Okay. And then for the next one, it says enter a credit balance of 18,300 as of February 1st. That's our accounts payable. And then we're going to credit accounts payable 2250 with the posting reference again of 73. That's the page in the journal it came from. How much was it? 2250. So all this ledger shows is what page in the journal it came from, the amount debit or credit of the transaction, and then the new balance. If it has a credit balance, and then we credit the account, again, we're going to add those together. So the new credit balance will be what, 20,550? And then this question, do rules of debit and credit apply to all companies? B, they do. All right. So when I ask, are there any questions about this? What I'm really asking is, do you think you could reproduce this on homework, right? Like, do you feel, or you're like, I don't know. Maybe if you go back and look at this. Okay. So again, all we're doing is taking this journal entry and putting it into a ledger where we can see what the new balance is. Okay. Probably the most confusing part of the references. And let me just walk through that really quick. So what we're saying is when we make our journal entry, we're saying we're going to post supplies to 15, which is the section of the journal, I'm sorry, of the ledger where the supplies account is. And we're going to post accounts payable to 21, which is the section of the ledger that accounts payable is in. And then when we come down to these ledger entries, we're saying, I made this journal entry on page 73. It's meant to allow anybody looking at the books to go back and find what page that was on, right? So that's probably the most confusing part to my brain. So I just don't do that anymore in the real world. All right. So here we're going to do the T account style ledger. Okay. So both of these are styles of ledgers. The first one we did, and now this one will be T accounts. So the first thing we have to do is journalize our transaction. We bill customers for fees earned of $112,700. So what's happening? We're billing them, though we're not getting any money yet. So instead of cash, accounts receivable is going to go up. And then fees earned is going to go up. Accounts receivable is an asset, so it'll go up with a debit, and fees earned is a revenue, so it will go up with a credit. So I'll debit accounts receivable, and then I'll credit fees earned. Think about it. Anytime you earn revenue, you either collect cash or you collect the promise to receive cash in the future, one or the other. So anytime you're crediting a revenue account like fees earned, you're either debiting the asset cash or debiting accounts receivable, one or the other. I guess in theory, there could be a third thing where like someone trades you some other asset instead of cash, like they give you a car for you doing the work for them. That does happen on occasion. I don't know. All right. Two, purchase supplies on account for 4,500. So my supplies are increasing. I'll debit supplies. And my liability accounts payable also increasing. So I'll credit that. Receive cash from customers on account. So this means people who owed us money are paying us. That means our cash will go up. We'll debit cash. And our accounts receivable, that's the account that indicates money owed to us by people, that will go down. I always love to get cash. I would way rather have cash than have somebody owe me, right? Because I can pay my employees with cash. It's hard to pay my employees with somebody else owing me, even though they're both assets. Okay, 88,220. Remember, I don't love money. I love getting paid, right? Because the love of money is the root of all evil. It says so. It doesn't say money is the root of all evil in the scripture. It says the love of money is the root of all evil. That's interesting to me. Money's a tool. We can use it how we need to. Putting our hearts on money can really hurt us. All right. You're like, thanks, Reverend. All right. Paid creditors on account 3,100. So if we paid our creditors, that means our cash is going down and our accounts payable is going down. So accounts payable, a liability, will decrease with a debit, and our cash and asset will decrease with a credit. All right. So there's all our journal entries. This is the stuff we learned yesterday. You're already experts at it, I'm sure. That's a joke. It takes a while to get used to it. Now we're supposed to post our entries into these T accounts. So if we look at like just the cash T account, what we're going to do is look through these entries and see where we did cash. And it looks like we debited cash on entry 3 and we credited cash on entry 4. So I'm going to put 3, which shows a debit of 88,220, and 4, which shows a credit of 3,100. Now to find the balance of that account, all I would have to do is subtract the smaller side from the bigger side. So I'd say 88,220 minus 3,100, which is 85,120. So this cash account has a balance, a debit balance of 85,120. This minus this. That's how we find the balance of the account. All right. Accounts payable looks like 2 and 4. We did entries that impacted that account. So in number 2, we credited it. We credited 400. So I'm going to put 2, or was it 4,500? Sorry. And then in transaction 4, we debited the account, 3,100. So what would we say the balance of accounts payable is after we've done that? Subtract the smaller side from the bigger side. So 4,500 minus 3,100 gives us $1,400. And is that balance on the credit side or the debit side? Credit. So we would say accounts payable has a credit balance of $1,400. What does that mean in real life? It means we owe our creditors, we owe people that we owe debts to $1,400 still. Okay. So this shows that during that period, we increased the amount we owed by 4,500 and decreased the amount we owed by 3,100, leaving us still owing 1,400. Okay. Supplies, looks like transaction 2 is the only one that impacted supplies. So I'm going to say transaction 2, 4,500. So this tells us that our new supplies balance is a debit balance of 4,500. Since supplies is an asset, that means we have $4,500 in supplies now. Okay. And then finally, fees. Oh, not finally. Fees earned. Looks like only one of the transactions impacted fees earned. Transaction 1 credited 112,700. So that means we've earned 112,700 in revenue during this period. Finally, accounts receivable. Looks like transaction 1 and transaction 3. In transaction 1, we debited accounts receivable 112,700. And in transaction 3, we credited 88,220. So what's the balance of our accounts receivable account? I'm going to use a calculator for that one. So I'm not that smart. So I take the bigger side, subtract the smaller side, and I find that the balance is 24,480, and that balance will go on the debit side, right? It goes on. So we take the bigger side, subtract the smaller side, and what's ever left over is the balance of what that bigger side was. I know that's a little confusing, but this has a debit balance. So this means people owe us $24,480. In the first transaction, the people owed us 112,700. In the second one, they paid off 88,220, leaving them still owing us 24,480. That's all we're doing here. And the more you do it, the more you'll be like, I can't believe this seems so kind of confusing at first, because it's just practice. Okay. All right. Assume that the unadjusted trial balance on July 31st shows a credit balance for accounts receivable. Does the credit balance mean an error has occurred? This is a tricky question because we haven't learned about trial balances yet. So I'm just going to put no, and we'll learn more about it when we learn about trial balances. So don't think too deeply about it. So what we just did, I just want to reiterate this, is we looked at two different styles of doing ledgers. Okay. The first style, this more complicated ledger that has the page numbers and the references, it's still the same thing. What it's doing is we're recording by account what the balance was, and then any changes to it to find the new debit or credit balance. The second one, the T account style, I think is simpler because we're just putting any debits or credits, but it's still by account. Okay. So usually if you're having to do this by hand, just to figure out the balances, most people just use the T account style. You don't need all of that extra like stuff. But if you're using accounting software and you click on ledger, it will usually have it in that ledger style so you can see how each transaction impacted the balance of the account. Okay. All right. So now we're ready to learn about the trial balance. So after we post everything to the ledger and we get to the end of our accounting period, we're ready to create our trial balance. This is the third step of the accounting process or the accounting cycle. The trial balance is a single document that shows the balances of all of the accounts that we have. In the olden days, when people prepared all the financial statements by hand, this was like a really great reference because it had all of the information you needed now to create your financial statements. Now, we don't usually create financial statements by hand. We record our transactions as we go, and then we go create statements, and it creates them for us, right? But people still use the trial balance because it's like a really handy summary of everything, and it's still in this debit and credit format, right? The thing about the income statement is not in the debit and credit format. It just has revenues, expenses, and then the net income. The balance sheet isn't, it just shows the balance of each of the accounts. So this still has this debit and credit format. So it's kind of the shorthand thing that most accountants will use to just see the summary of what's going on with the company. So the trial balance just has all of the accounts listed and all the accounts that have balances, and then their balance, either as a debit or a credit. And here's where we can say, does it balance? Because it has to. You always have to have the same amount of debits as you have credits. So at a glance, as an accountant, when I look at a trial balance, I can see if I was off somewhere. Like if I don't have the same amount of debits as I do credits, it means I made an error. And I can fix that before I send reports out to the client. Think about it. If you screw up as an accountant, especially for like a publicly traded company, and you put data out there that's incorrect, investors may make decisions to invest in the company on faulty data. Lenders may make decisions about whether or not to lend you money on faulty data. The IRS may charge you taxes based on faulty data, all of which can get you in real trouble, not only financially, but even legally. So you want to have a means of sort of checking things before you put them out there to the whole world, right? For a smaller company, it's not as much like legal, but still it's the data and information that you're making decisions based on. So just being able, even if your accountant's going to do your work for you, you should know enough accounting to be like, that seems off or weird before you make decisions on it. All right. So just so you know, these are always in the same order. All of the asset accounts are listed first. So for this, we have cash, accounts receivable, supplies, prepaid insurance, land, office equipment. That's all of their assets. Then the liabilities, accounts payable, unearned rent. Then the equity, common stock, dividends, and dividends. So the balance sheet accounts are put first, and they're in that same order: assets, liabilities, equity that the balance sheet is put in. Then the revenues and the expenses, and that's it. So they're always in that order: assets, liabilities, equity, dividends, revenues, expenses. Okay, again, something you get used to over time, but it's not so obvious the first time you're looking at it. So that's a trial balance. And it's called an unadjusted trial balance because we're going to learn how to make adjustments to it in the next chapter. So let's look at the third question on here. Whoa. All right. So here, now they've given us the T accounts for the company. So someone's done the work of the journal entries and then recording those over to these T account ledgers. And now we're supposed to use this information to create a trial balance. Here's a nice little way they have this set up, that they're in order, right? We have assets. No, they're not. Maybe they're this way: assets, cash, accounts receivable, supplies, equipment, then liability, then stock, then dividends, then revenue and expenses. So they're in that order. So we're going to put them in that order: cash, then accounts receivable, then supplies. So I'm just kind of going down the columns of the T accounts here. Then we have equipment, accounts payable, and common stock. And then dividends, service revenue, and operating expenses. And then we have to find the balances of each of these. Some of it will be really easy, like equipment only has one entry, but like cash has a bunch of entries. So what do? Well, we're going to add up the debit side to find the total of the debits, add up the credit side to find the total of the credits, and then subtract the smaller one from the bigger one. I found Excel to be a nice tool for this, for me. Anybody else do it? I got 30,425. All I did was I added up the debit side. This is the cash account. And then I added up the credit side, got the balance of those. And then I subtracted the smaller side, which was the credit side, from the debit side, leaving me with a debit balance of 30,425. So then I'm just going to come on here and put 30,425. That's the debit balance of my cash account. Again, you may find yourself tempted to just punch in the numbers as I do them. Try to learn as you go. I know sometimes we're going so fast it's hard, but all right. Accounts receivable had a debit of 20,500 and a credit of 13,100. So minus 13,100. So accounts receivable has a debit balance of 7,400. Supplies has a debit of 4,000 and a credit of 2,200. So the balance of supplies should be 4,000 minus 2,200, which is $1,800, right, on the debit side. Equipment just has a debit of 15,000, so its balance is 15,000 on the debit side. You'll notice each of these follows the rules of the normal balance. Right? With assets, that's the side, the debit is the side that increases it. So we would expect to see assets have debit balances, and they all do. When something doesn't have a balance according to its normal balance, it's a sign that you either made a mistake or you have something unusual. It's worth checking out. Okay. Liabilities, accounts payable. There was a debit of 6,000 and a credit of 10,000. So if I take 10,000 minus 6,000, I'm left with a credit balance of $4,000. Common stock just has a credit of 40,000. So we'll say it has a credit balance of 40,000. Dividends just has a debit of 1,500. Revenue just has a credit of 20,500. And then our operating expense had a debit of 6,175 and a debit of 2,200. So to find that balance, we would just add those two together since they're on the same side. And that's 8,375. Then all we do is add up each side, and that'll give us the balance of our trial balance. So the debit side is 64,500. What? Where to do the sum? This little button up here looks like a Greek sigma. Yeah, that'll just do auto sum. Super dope. And then here on the credit side, we have 4,000. I'll do the same thing. I'll click sum. And they balance, and something feels right with the universe. Like that. It's a universe of order once again. Okay. It's always been a universe of order. If it's ever feels out of order, it's you. It's not the universe. Okay. That's another principle. All right. Based upon the unadjusted trial balance, determine the net income or net loss. How could we use this information to know what our net income or net loss is? What is net income? What? What you've made. And mathematically, what is it? Revenue minus expenses, right? So if we look on here, we can just look at our revenue minus our expenses, and that will give us the net income. So we had a revenue of 20,500. We had expenses of 8,375. So our net income is $12,125. Bam. I know what you're thinking. That's only 75%. We've only got 2 minutes of class left. Holy, that's probably what you were thinking. Maybe not. Anyway, so the last problem is I just want to show you something that we call horizontal analysis. And this is a way that we look at financial statements to see how things have changed over time. So this shows the income statement for 2 years, 2016 and 2017. They almost always put the newest year on the left side and the older year on the right side. And then here's the analysis. We find the amount of the increase or decrease and the percent of the increase or decrease. We do that by taking the older year minus the newer year. So that shows that we went up 37,500 from 2016 to 2017. Here's 60 minus 45, $15,000. And then to find the percentage, we just take the amount of the change divided by the older year. That'll show us the percent change. Okay. So in the next minute, might take us two, sorry, we will look at this problem. So we have the Paragon Company. This is a really shortened income statement. It just has fees earned, expenses, and net income. So now we're supposed to figure out how it's changed. So to do that, again, I'm just going to take the 2017 number, 1416000, minus the 2016 number, 1200, and see that it went up, it increased $216,000. So our revenue increased $216,000 from 2016 to 2017. And then to find the percent difference, I'm going to take that amount of increase and divide it by the 2016 number. So 216,000 divided by 1,200,000, 18.18, which is 18%. So we could say our revenue has increased by 18%. We'll do the same thing for expenses, 1,044,000 minus 900,000 means expenses increased by 144,000. We take 144,000 and divide that by 900,000. We'll say our expenses increased by 16%. I know I'm doing it quick. Is everybody following or no? Ish? Okay. Finally, net income, we do the same thing. 372 minus 300. We have a $72,000 increase in net income. And then 72,000 divided by 300,000 is a 24% increase. And from an analysis standpoint, we'd say, hey, if our revenue is going up by 18% and our expenses are going down by 16%, that's a good thing, right? We're going to make more profit and we'll get to buy that new Corvette. Yeah. %16. All right, everybody. Have a great day.